Good morning. Andrew Benioff with Lenrock Group and the Lenrock blog. Happy to be joined today by Eric Baum, Managing Director of Resource Real Estate Funding Incorporated. Eric, thanks for joining me.
Thank you
Appreciate
for having me.
Thank
It's great
you.
to be here.
So, as I said, Eric is a Managing Director at Resource Real Estate Funding. It's a national real estate firm that specializes in opportunistic and value-add investing and financing of commercial real estate assets, with an emphasis on multifamily, but also doing other asset classes as well, I believe. Eric is responsible for the origination, underwriting, and closing efforts for the properties that they finance. So Eric, let's talk about for a second new deals that you're seeing today, as opposed to, say, 12, 18, 24 months ago. What issues are you seeing pop up now that you haven't seen in the near past?
Yeah, I think our biggest concern right now is how aggressively can we underwrite deals as far as rent growth, occupancy, expenses.
Sure.
There just seems to be a general slowdown in the economy. So we're being very mindful of how we're underwriting deals because of that. 2 years ago, you could take a multifamily deal, for example, and easily underwrite 3 to 5% rent growth per year. After the capital improvements have been done, and now we're dialing that back.
Interesting.
And we're being very careful. And really depends on each market. Each market has its own intrinsic qualities.
Sure.
But I think overall it's just a dialing back of underwriting standards. And then also I would say that certain product types, like suburban office, we are generally shying away from now.
Interesting. Okay.
Unless it's a suburban location that's tied to a major metro. For example, Philadelphia, we would look at some suburban office in Philadelphia, New York, of course, LA, Chicago. But if you're entering kind of the smaller cities, I think we're going to be more careful.
Interesting.
And along with that, we'd probably dial back the leverage for those suburban deals. So maybe 12 months ago, we were at 75% of cost. Today we may be at 65 to 70.
Got it. Interesting, okay. So let's talk about for a moment the general economy and how it affects your platform and your outlook. Janet Yellen said that interest rates aren't going to be changing anytime soon, but it's inevitable that they're going to rise again. We're here at the Philadelphia Capital Markets Summit today, just outside of Philly, put on by the Mid-Atlantic Real Estate Journal. And one of the panelists on the banking panel, the first panel, was Joel Naroff of Naroff Associates, who's an economist. And he's talking also about, he was saying earlier today that interest rates, he doesn't see them, obviously foreseeing something large that changes, he doesn't see them rising in the near future. I think that means 6 to 9 to 12 months maybe. After that, who knows? But he also doesn't see a major blip on the horizon also that's going to change our economic condition. But how do you prepare? How do you think about interest rates and that they're eventually going to rise, devalue your the asset cash flows, affecting asset prices, et cetera? When you're sitting with your group, how do you think about that?
It's a great question, and it's something we've talked about for the last 2 years. So I think what we generally do is we'll stress cap rates, where in each product type or each asset type has its own cap rate. Generally for multifamily, we're going to be a little bit more aggressive. For the suburban office and for unanchored retail, we'll grow cap rates a little bit more widely. So I think it's stressing cap rates. Again, going back to what I said earlier about being conservative on our underwriting, and then exiting, looking at a refinance exit versus a sale exit. So what I mean by that is, there are some lenders out there that assume a sale exit. We never look at a sale exit. We're always looking at stressing cash flow, looking at a debt yield exit test that, again, for different property types, we'll look at, for instance, multifamily will be at a 9, minimum of a 9 going out for office and
Of debt yield?
debt yield, yeah. Office and other property types, we might be at a 10 to 12. For hotels, we might be at a 13. So unless, and again, that's based on our more conservative underwriting. So we feel with the stressing of the cap rates, with the debt yield hurdle going out, and then, generally being more conservative on leverage today than we were a couple of years ago, we feel that we'd be able to exit even with some growth in interest rates. And we're of the mindset that we don't see a major pop in interest rates anytime soon. I think it'll be a gradual increase. The economy just can't withstand a major move in interest rates anytime soon. So I think I kind of agree with what was said earlier. I think it's a year to 2 years. Our deals are generally 3-1-1, so we're within that time frame. So we do need to be mindful of how we underwrite our deals.
Great.